Hello?
Sean, we don't have your voice, do we?
Nope.
Hello.
There he is.
Hello.
Mhm.
Hello.
Hello.
Okay.
We got you now, but no picture.
Okay. There we go. The gremlins are back. See what happens when we start talking about things. Okay. 5, 4, 3, 2, 1. Welcome to the Daily Energy Markets Podcast, Friday, January the 27th. We have oil trading up in Asia. Crude at 80, Brent and WTI at 81.41 and Brent at 87.90. This January month continues to demonstrate what our good friend Alan Greenspan once called irrational exuberance. It's been a bionic start to the new year. All financial classes seem to be moving in one direction, all it would appear on China. Let's kick off this morning with Jorge Montepicu, president and founder of Global Markets. Jorge, do you think the Fed and its sort of peer group are going to need to maintain the robust tightening cycle, i.e. maybe 50 basis points to keep this January irrational exuberance inflation under control? Your thoughts as we come to the end of January?
Well, good morning and good morning to the world. I really don't think so.
Okay.
I think inflation, the big fear we all had, and we faced it, was the previous year in 2022. As we enter this year, the big dragon woke up, didn't it? And the big dragon is busy getting up to work. And that will mean that all the supply chain issues will start easing. And that is going to have a massive change on the measurement of inflation of year on year. Of course, if we measure the inflation level in 2023 versus 2021, we'll have massive inflation. But how you measure inflation is year on year. And year on year, inflation is going to start coming down on the manufacturing sector. The trend is going to start leveling out. In addition, the rest of the world in key parts is slowing down a little bit as well. So we face inflation from an energy point of view last year, as the supply chains in oil and gas got all messed up, and we had a huge fear about war, the war impact. Now, I hate to say it, despite the huge death of young people on both sides, is in our brains is a chronic issue now. It's wake up in the morning, there's war, wake up the following day, there's war, we will wake up next week, and there'll be war. But in our ethos, we're no longer worried about gas is going to be cut off, oil is going to be cut off. We all have been desensitized to the sanctions because we know that the Russians, the Iranians, the Chinese, the Indians, the Europeans themselves, they find their own ways about the sanctions. So as it happens then, year on year, energy is not going up. Energy is catching up with the levels of last year. It will be very hard for anyone to make a point that the price of gas will be higher this year or next versus 2022. So if we put all of that together in one place, what we get is rising energy, but not rising energy above last year's peaks, but definitely a trending up market. And we get metals going up but not with the type of scare we have last year that there wasn't going to be copper and aluminum and all those key inputs into industrial processes. And all the factories get churning, which increase the price, but again, not above last year's peaks. So I think we're going to have very nice surprises this year in terms of the cooling off of inflation. If you're an oil man, in the oil price rising, but again, not above last year's peaks. And the Federal Reserve going, we need to start pausing. So for all of us who definitely still have mortgages despite our age, we are looking at this and going, not too bad. And you start seeing some elements of market recovery, definitely in the real estate market, definitely in the strangest place of all, in the third world. Where things are happening right now is in the third world. The rate of recovery, of growth is unbelievable.
So we're seeing that in the MSCI index, the emerging markets equities index, up 20% or up, 20%, I think it was. Let's go to Richard Rigoglia, CEO at Matrix Global Holdings in San Diego. Richard, do you share Jorge's sort of positive, optimistic outlook that we're going to get that soft landing? I mean, the Fed has made a very, very big effort to get this sort of inflation under control, and yet we're still seeing full employment in the US. We're seeing GDP growth in the fourth quarter of 2.9%, and inflation still above 6%.
I do agree to an extent. I think, there's two kinds of inflation. There's cost push and wage pull, and I tend to think we're going to start to get to the wage pull here. So I agree. When we look back at a comparison to 22, I think we have to be conscious. Right, we might see a leveling off, but we go back to 20 and 21. I still think we still will have higher levels of inflation, but I think we're really starting to see here in the States as Walmart came out today and said the opening job now is $15. The concept of a minimum wage is almost gone by the wayside. We're seeing millennials saying, I'm not going to work because I can be on TikTok all day and get chat GPT to do something for me. So I'm not too sure about that. I'm cautious on when we talk about inflation. What exactly are we talking about? I fully agree that the supply chains is going to get fixed, that the third world is starting to rebound, which has an inflationary aspect to it. But let's not forget, the U.S. just passed a $1.6 trillion climate change bill. That's going to come in the printing of money. So no one's giving up the printing of money. That hasn't really stopped. I think if Lagarde has anything to say, I believe there's some continued bond buying going on by both the EU and the Japanese central bank. So I've always tended to believe that where inflation came from, while we had these other issues that came to the table, we always were printing money. And that was one of the major factors that led to the spikes that we experienced. As it relates to energy, I've been saying this for a long time now. 22 never bothered me, and 23 really was an issue. I think it's 23, 24, and 25. We talk about the oil price. Where's it going to go? Below 80, above 90? Where we're going to talk? I tend to think of this as in this longer term play. We're solving some of the oil price issues, but are we really? All investments going into the renewable sector, and where I said just before we came on, one thing we know about oil demand is it always rises. And when you look at the IEA and the EIA numbers that are coming out, they talk about oil demand going up to 102.5, 103, I think 104 by 2025. Those are the questions I think that they're going to come back when we talk about what we're in here is about talking about the energy markets. I think it's going to be the bigger driving force. And how will the market deal with that? How will it deal with higher energy prices? Agreed. And I agree with Jorge. We won't see the spike prices, but we will continue to see steady prices.
Daniel Rahmat, Senior Energy Security Consultant in Tehran. Daniel, if you might just talk a little bit, one of the things that may be keeping oil prices a little bit stuck in the 80s, as I am in so many ways, but nonetheless, the oil price stuck in the 80s because Iranian oil and all of that floating storage we talked about last year seems to be making its way into Chinese storage. Your thoughts and outlook for Iranian oil making its way to market, just like Russian oil is?
Good morning, Sean. It's a great pleasure to be with Richard and Jorge in the same panel for the first time. About the Iranian storage, floating storage, there are several issues getting the problem somehow very complicated. After the EU ban on Russian oil, many tankers, not the ones which belong to the Iranian National Tanker Company, the ones which are from private sector, either Iranian or foreign, are just moving upwards to Russia to somehow carry the Russian oil instead of Iranian sanctioned oil. So Iran is somehow in trouble with finding some floating storage, which normally Iran uses own tankers. So the reason that Iran is reducing the volume of its storage and delivering most of that to China is not just because there are more consumption in China, but also Iran is facing some hardship for finding tankers to reserve its oil and condensate in the East Asia. And on the other hand, I think there are some other types of issues occurring. Iran is now issuing permissions for somehow other companies or individuals for exporting crude oil to foreign customers, but the NIOC itself. So many people, including the military, including some very strong cartels here, economic and financial cartels here, are now able to export Iranian oil. So Iran's marketing capabilities in China has increased because many other private and individuals are now getting involved in exporting oil. By the way, Iranian exports has significantly increased to China, but I'm not sure whether that's going to be sustainable because of the problems I told you.
Are we seeing a corresponding increase, Daniel, in Iranian oil production, or is it simply the oil that has been in storage making its way to the customer, and at some point that ends?
Based on the information published by OPEC and other energy intelligence firms, the amount of production has also increased, but that's not that significant, which the amount of exports is. So I think that would be a sort of limit for that increasing, unless Iran can somehow make a sort of revolutionary action in its production sector, which I have serious doubt about. We have recently many rumors and news, some of them relatable and some of them not yet, about some disruptions in Iranian oil exports or production, and especially the gas production. Not only the production, but also the delivery into the national network. So Iran has significant decrease in its gas exports to Turkey, and well, natural gas is not the case of our discussion right now, but I think there are many technical problems occurring in the Iranian oil industry, which would limit Iran's capacity for more exports unless the sanctions are lifted and some technical aid Iran can receive. So I think that would have a limit.
Jorge, I wanted just to drill down a little bit into your sort of optimistic outlook that the sort of commodity spike will be managed this year. We have outlook now for no recession or shallow recession. We have China coming back, obviously still to roar, but nonetheless coming back and still close to 2 million barrels of oil below 2019 levels in the Chinese demand. So there's a big possible return there. Return to LNG markets in a year in which Europe is now nearly completely dependent on LNG going into its next cycle. I'm wondering, how do those things sort of come together and yet all remain calm when we've got economic growth in China back above 5%, Europe not in recession, and yet heavily dependent on LNG?
Great question. And the issue is that markets always balanced through price. Consumption is always met by demand via inventories. And the discussion of Iran is a very good example. As the market spiked and got backwardated last year, inventories got drained out. So Iran's inventories floating were drained out. As we enter the new 2023 and China comes back, China consumes more and there is no supply, no huge new supply. And the existing sources of supply are still a little cranky, is the word that we use. So somebody needs to compensate for that. Who is compensating for that? Europe. Europe is the slow poke in the entire process. Europe has self-harmed itself. There is a lot of energy savings in Europe, and the IEA has put out a lot of studies explaining that, but essentially industry is calling it quits. If you look at the car production in the UK, it's at a 67-year low. Who wants to manufacture anything that is energy intensive in Europe? So the industry,
which is a long decline. I mean, the UK story is a long decline, but Germany, now there is a very interesting outlook from the point of view. I mean, Germany's at record employment.
But everybody's at a record employment, by the way. There is no labor anywhere. It's one of the greatest mysteries post-COVID. What happened? Did COVID kill everybody or what? Anybody that work? I have been traveling, as we were discussing before the start of the podcast, and I am very bullish on the third world. The information on Morocco is it has outpaced France and Spain in the last 20 years in terms of growth. You look at the growth in Mexico, is every restaurant is looking for help, from cook to cashier. You go to Guatemala, the same thing. My son was in Colombia, the same thing. You talk to people that are traveling in Africa, same thing everywhere. It's just growth. And in Europe, there is full employment. You cannot find labor, but the pool is smaller. Some countries are shrinking. China has started to shrink, actually, but Japan is in a very long-term decline. So what we're talking about here is the degree of change. And where is that degree of change is happening? Energy-intensive industry in Europe is looking for other places to go or to shut down. So there will be effectively a reduction in industrial use in Europe, which is being picked up by China. So what we have is a remarkable change between East and West and North and South. So sorry to be so terribly blunt, but the sick men in the entire planet is the European and definitely the Japanese.
And yet they're still in full employment. It's a weird sickness, Richard. The outlook for the idea of curtailing growth and interest rates being that tool, are we seeing the markets essentially wrestle or call the Fed's bluff, so to speak? I mean, inflation, I don't know where you look at it, depending on it, but it seems to be bedded in everywhere. Single-digit inflation is I don't see it. I only see double inflation. Jorge, or was it you, Richard, mentioning that the U.S.
The minimum wage
is $7.50, I think, and actually the reality is 15. That's double. That's not 5%.
It is not 5%, and I think who am I to talk about what the Fed is going to do? And I could speculate all day long, but what Jorge said is exactly my point.
But what is the point about the Fed question is the Fed going to carry out its mandate to get interest rates to 2%? That's its job.
Are you asking, do I think the Fed's going to do its job? Is that your question?
Well,
No. The Fed signs off on trillions of dollars of debt a year. What do we talk? We don't want to go down the rabbit hole. That's
Yeah.
usually your Monday talk is usually on
Yeah.
how the world's melting down. I think we're printing trillions of dollars. We're going to have wage inflation across the world. Europe is paying a price. Europe is paying a price for the agenda that it chose to follow, and that is an agenda of removing hydrocarbons from the equation. It laughed at Trump. The Germans laughed at Trump when he said you're going to be held hostage by the Russians. Everybody laughed and said, and they all went on their merry way. And here we are. They're caught. They're stuck, and there is no out for them. What we're going to see with LNG next year and the year after, every port's going to have to be expanded. 15 years ago, we stopped investing in coal, and now coal is the highest price it's ever been. How is that possible? Well, what are we doing now? We're stopping investing in oil. U.S. oil production might get to 12.4, 12.8, I saw in 2024. U.S. production should be at 14 million barrels. We should be drilling everywhere all the time. We should be trying to we can balance our payments. And what are we doing? And you might not see this. So the House of Representatives now, we have a split government. And and they came out and said, we will allow Biden to release from the SPR, which remember everybody, we released probably 220 million barrels of SPRs released last year. Let's not forget that aside, which helped balance everything. That was a political game to get people elected. But what really is important is that the Republican Congress came out, or House came out and said, we'll let you reduce the SPR by 5% if you allow 5% release of federal lands for drilling. And that's going to get vetoed. So think about that. You can sell our oil, but we're not going to let you find it on your own ground. So I think we're in this unbelievable dream state of people hoping things are going to be okay. I agree 100% with Jorge. I think the third world is going to see significant demand increases, and those demand increases are going to be met how? People are going to want to.
But when you sum the two of you and Jorge, how do you get to the answer that energy prices will be sub what they were last year? I mean, both of you are signaling shortage of production, massive growth, China back. How do we not get to 100 plus oil?
Oh, I think we do. I don't agree with her. I think I forgot what the spike was. I mean, I think we can be $100.
The spike was 130, but that was the days after the war in Ukraine. I
think we are trending higher, and we're going to trend higher between now and 2025, 2026. I think we're on an upward trend that's not going to let go. You're not going to make enough green hydrogen to store. We're not going to have enough wind and solar to produce power. That is going to be met by fuel oil demand, because we'll run out, because LNG is going to get shoved all around the world into as everyone was saying, into Europe, to make them just keep the lights on. So I think the problem is upon us. I think it's, we talk about the war. We say the war. Well, what happens when M1 tanks go into and Leopard tanks go into Ukraine?
Exactly.
What happens when a missile takes out one of these tanks? I sure hope it's not a U.S. soldier.
A year ago. I mean, I said this yesterday. I want to say it every day. A year ago, Germany offered 5,000 helmets.
I heard you say that.
And today they're giving Leopards tanks. This is not going away, this problem. Let's go to Iran. I want to get Daniel's opportunity to give us an insight, as much as you're comfortable sharing, Daniel. I know there are limits in your situation, but what is the current outlook for Iran the year ahead? It appears, at least from the outside, to have got this current challenge under control, although incredibly ugly and uncomfortable to watch, at least on the TV from our perspective. Nonetheless, is it under control, or is it a real challenge to the balance and stability of Iran this year?
If you consider the reason the people are in the streets, or they were in the streets at least at the last month, they're very fundamental demands. And those types of demands which we are talking about are mostly originated from if you look at them through a sort of economic prospect, you will understand that they're mostly originated from the economic or very fundamental rights actually basis. So these, until you have not resolved the very critical and very serious economic issues in this country, you know, as one of the richest countries in the world in terms of hydrocarbon reserves and mineral reserves, human resource, and blah blah, you cannot even supply natural gas to the nation. So that's what people are demanding in the streets. What the hell is going on in this country? You know, so you have some geopolitical goals, you have some political targets, you have some ideological beliefs and everything. Apart from them, you have to supply the minimum rights of the people in your own borders. So this is the ongoing crisis in this country. You know, several decades ago, in this country, we had one protest and demonstration, remarkable one, every 10 years. But right now, every year we have one of them. This shows that the crisis is getting more serious. Despite the streets in Tehran and other cities in the country are now calm and there is no protest going on, everybody, including the establishment itself, they know that they need to get to a sort of conclusion to the very fundamental problems of this country. But I think Iran is now inside or deep inside a geopolitical well, what I define it as a place where nobody wants you to get out of that. You know, everybody around this country is naturally competing with Iran in terms of geopolitical interests and geopolitical goals, especially Turkey and Saudi Arabia. They have serious competition with Iran. But none of them wants Iran to become a very strong and very advanced, and this is something everybody knows. But when you're deep down there, and then you don't have any friend up there, up on the ground, you cannot get yourself rid of the current situation. Iran has shifted from the Europe, you know, in 1979, Iran shifted from the United States towards East, and then started doing more cooperation with the EU, and later shifted from the EU to the East, which is believed to be Russia and China. And recently, last year, absolutely shifted from China to the Russian Federation, to Moscow, which is deep inside a war with the rest of the world. So now Iran is practically getting involved in the problem in Ukraine and East Europe, which has nothing to do with Iran's interest with delivering technology or assistance to the Russian military. So
well, they were already allies fighting and prosecuting a war in Syria for many years. Now they're allies prosecuting a war in the Ukraine.
But the situation in Ukraine is absolutely different. You know, the war in Ukraine is a very, very close, as you said, Germany last year just offered 500 helmets to Ukraine, and now they're delivering Leopard tanks to them because the threat is very real there in Europe. You know, the threat for the rest of the world in Syria was somehow as getting another country or conquesting another capital or not. Right. But now the threat in Ukraine is very real for the Europeans. If they don't stop the Russians there, they have to fight in their own homeland with them. So I think Iran does not necessarily understand how dangerous the game in Ukraine for Iran is. And considering that the natural gas and oil industry in Iran is absolutely dependent on China, and in terms of technology, it's absolutely dependent on European technology. The deadline for Iran to come back is very short, because if China stops buying Iranian oil, everything would collapse. And if Iran cannot get finance or technology from other countries, the same thing will happen. So Iran needs
that
to
might be
get
the
back
outcome.
to the table.
I mean, last year we lived with the possibility that sort of when next day, tomorrow, Iran will come back with lots of millions of barrels. This year it might be Iran production declining by millions of barrels. Jorge, give you the last word this morning with the survey question, which is sort of filtered through some of our conversation. Does the Fed and its buddies need to maintain a robust tightening cycle, i.e. 50 basis points, to keep January irrational exuberance inflation in the bottle? Does it have the bottle to stay the course with 2% interest rates, 2% target on inflation. It seems to me the market is betting that they don't have the stomach to stick with this target. But does the Fed need to, if it wants to control, get this inflation back? That's the question. Jorge, your closing thoughts. I know you wanted to jump in there a little bit. Did we lose you? I think
No,
we
no,
might have-
I am here. I wanted to say,
Please.
or to clarify something
Yep.
about the expected price increase. I
Yeah.
was very vocal on the fact that we are not going to see the spikes we saw last year. But that
i.e.
doesn't
the
mean-
spikes being the post-Ukraine war, i.e. 130.
Yeah, 130 and
The
gas-
average for the year was 100 on Brent.
Oh, no, we're going to pass the average as soon as before IE week, where the world petroleum was canceled. That will happen this winter. But I am very clear on the spikes. Some of the spikes were stratospheric in nature, as markets are. What we're going to see this year is more of a steady grind, and definitely above last year's average. So it's a good time for the oil companies, for their stock. It's a good time for everybody. But in terms of the rate of growth, year on year is coming down. And as these issues with the supply chains are improved, the Fed can claim victory. And so can the US government. We know how those things operate at the top, where they're forever influencing each other, hopefully for the well-being of their countries, but they're going to claim victory, that the inflation genie has been bottled up. So I am of the thinking that past Q1, the signals from the Fed will be dovish for the rest of the year. Thank you for the opportunity.
Dovish for the rest of the year. I'm going to sort of put a little question around the smoothness of the supply chain. I'm not sure how smooth that's going to be settled out at a time in which Apple are saying they want to move 50% of their iPhone production from China to India. What challenge does that whole redistribution of supply chain, repatriation of to West, microchips in the US, for example, there's some part of $80 billion plus being spent. I mean, supply chain returning to what it was pre-COVID in China, I'm not so sure, because structurally so much is under question at the moment by Daimler, Chrysler, Daimler-Benz, by Apple, by so many others who've used China as their manufacturing base for the last 20 years increasingly. That period is over. The repatriation, the structural shift of supply chain away from China over the next 10 years, I think creates supply chain disruption rather than smoothness. But maybe smoothness in the short term. We will have to see. Jorge, thank you so much. As always, Richard, great to have your insights. And Daniel, really enjoyed the conversation. Brent crude trading up this morning, trying to get to 90, but keeps dropping back when it sniffs the heights. And we'll have to see where it goes. Have a great weekend, everybody. All the best.
Thanks,
Thank
everybody.
you.
Thank you.
Cheers, everybody.
Thank
Bye.
you. Bye.